Now, I'm going to introduce an advanced price action strategy that you can use alongside these patterns. This is the same strategy I use to achieve strong returns. To start, you'll want to prioritize higher time frames. Any time frame at or above the 1-hour chart is better. This is because candlestick patterns are generally much less effective on lower time frames. So, the first step of the strategy is to identify a key level on a chart. There are many types of key levels, like support and resistance, dynamic key levels, trend lines, Fibonacci levels, and more. I won't discuss all of them in this video because it would take too long, but to keep things simple for this tutorial, we can start by finding support and resistance levels or trend lines. Here's an example. In this chart, we can see the price has formed a downtrend and reversed twice at a specific area, making it a level of support. Now that we've identified our key level, the next step is to wait for the price to interact with it once again. At this third retracement, we're expecting the price to bounce once more, but we'll need extra confirmation from a candlestick pattern that supports our uptrend bias. In this example, we see a large red candle, followed by a smaller red candle, and then a large green candle, which closes above the body of the first candle. If you remember from the patterns we've learned, this matches the characteristics of a bullish 3-bar reversal pattern, suggesting that the price may reverse to the upside. You can enter a buy position at the high of the third candle, place a stop loss at the low of the second candle, and set a take profit target at twice the size of the stop loss. As you can see, after our entry, the price moved up, hitting our take profit target. Here's another example. In this chart, we see that the price is in a downtrend, and it has formed a support-turned-resistance level. This happens because the price initially formed a support level, as price rejected it once, but then price broke below it and is now approaching it again from the bottom, making this an area of resistance. However, we also see that the price has made 2 lower high points, creating a strong trend line. This area where the trend line and resistance level intersect is called a confluence level, an area where multiple key levels meet. Price is more likely to reverse at a confluence level. Now, we wait for the price to reach this confluence level. Once it does, we anticipate a reversal, but we still need confirmation. Looking closely, we see 3 green candles, each getting smaller in size, followed by a large red candle. This pattern shows that, as the price approached our confluence level, buying pressure was fading, giving sellers the opportunity to step in. This is the characteristic of a shrinking candle pattern, which strengthens our expectation that the price will reverse downward from this level. This setup provides a good opportunity to enter short. Then, you can place a stop loss above the high of the previous candle and set a take profit at twice the size of the stop loss. As you can see, the price moved down and reached our profit target shortly after entry. Now, if you've watched the tutorial this far, I assume you're one of the few people who are truly serious about learning how to trade. So if you're serious about leveling up your trading skills, join the free community. I'll see you there.